Okay, hi everyone. We're already 5 minutes in because was waiting for Vantage to start on the other platforms. We have now started. It's okay. We'll just if I cannot finish it within an hour, we can just do that. We'll just do that extra 5 minutes that we ate into. Okay, hi everyone. Welcome to today's webinar brought to you by Vantage. Okay, we're gonna be doing why Forex traders must watch bond markets. It is important if you are a Forex trader, you should know why you should be watching the bond markets. You could be like me. I used to only trade technical analysis. I was profitable, but then now I started combining fundamental analysis and I started to become even more profitable. Okay, so once again, hi everyone. How is everyone doing? Just let me know in the chat box so that this webinar can be a little bit more interactive. It's better for you, it's better for me so that it's not so dry, you know? It's not so dry if you guys are talking to me. Okay, so let me know where you guys are tuning in from. Drop your country, your city, whatever it is in the chat box so that I kind of have a rough idea of where the room is. Okay, again, I want this webinar to be interactive. Thanks for those who said hi to me earlier on. Those who let me know that the audio is working, screen is working. Okay, thank you for that. So yeah, okay, let's start. Oh, before we begin, you guys already know how this works. I do have to go through the disclaimer. It's going to be a very quick one. It's going to take a minute or two at most. Okay, so this webinar is purely for educational purposes only. Everything I share today is based on my own analysis, observation, and my own experience as a trader and an analyst. This is not a signal service or financial advice or any form of investment advice. I'm not telling you to buy, I'm not telling you to sell. I'm basically here to share information. Okay, the goal is to help you understand why the markets move the way they do and how you can apply that understanding when you are trading with Vantage. Okay, trading is always risky. There's always risk. I mean, it doesn't have to be trading, it's anything really, especially when you are dealing with volatile markets. Okay, so make sure you trade responsibly, manage your own exposure wisely, and use today's insights as your own informed decision making. Okay, I'm gonna have to stay here for a minute or two so that you guys can read through the disclaimer. But yes, it's basically a reminder that this webinar is purely educational, not a signals group, not giving you any form of advice financially or investment wise. Okay, so we will continue in a minute or two. Please read the disclaimer. Yes, drink some water before we start. Get comfortable. Okay, that's a minute or 2 minutes rather. Let me continue. So I'm going to introduce myself. Let me do this really quickly. My name is Cassandra. I am an investment analyst at Everest Fortune Group. We are based in Singapore. We have been recognized as the best finalists, the finalists for the best Forex and equity research for multiple years running. So we do a lot of back testing, a lot of research, a lot of um, um, forecasting of where we think the markets are going. We basically spend a lot of time understanding and researching the market. So you guys are in good hands. If you guys have any questions you want to ask me in the chat box. I'll try my best to answer you. Don't have to worry about being judged or anything. You don't have to be shy. The whole point of Vantage bringing these webinars to you guys is to help you guys, um, to give you guys a platform and somewhere you can talk to a professional trader. And yeah, so if you have any questions, anything, it doesn't even have to be related to today's topic, just ask away in the chat. And I'll try my best to help you get through whatever challenges you are facing with trading. I think a lot of people are just facing a lot of my mindset issues, which really just you just need to collaborate your own psychology, trading psychology, and it will help a lot. Okay, so yeah, our agenda for today, how bond yields lead Forex direction, yield curves as recession and trend indicators, short end versus the long end yields, and bond, the Forex divergence as a trading signal. Okay, so let's start with how bond yields lead Forex direction. Okay, let's start with a very uncomfortable truth for most Forex traders, because once you see this clearly, it's impossible to unsee it, to be honest. So the Forex market does not usually price macro expectations first. Okay, we've done many of these kind of topics, fundamental topics, economic topics, microeconomic topics, and I always say that um things are always priced in before it actually is happens. Okay, so Forex often reacts after the groundwork has already been laid somewhere else. Okay, think about who trades bonds. Okay, these are not the short-term speculators clicking buy or sell because of a candlestick pattern. This is where pension funds, insurance companies, sovereign wealth funds, and central banks operate. Okay, these participants are not trying to be clever. They are trying to allocate capital based on where the economy, inflation, and policy are heading over the next several quarters or even years. Okay, so when these institutions change their view on growth, inflation, or central bank direction, they don't express that view by buying EUR/USD or USD/JPY first. Okay, they express it by buying or selling bonds. Okay, that's where expectations get repriced. Forex then adjusts because currencies are simply the exchange rates expression of those capital flows. This is why if you only look at Forex charts, markets move often feel sudden or irrational. A currency pair might sit in a tight range for weeks, then suddenly break the trend aggressively. From the Forex perspective, it looks like something random just happened. Okay, nothing in trading, nothing in investment is ever random. There's always a pattern. Okay, but in reality, okay, bond markets have often been trending quietly for some time, signaling that the macro environment has already shifted. Okay, so another way to think about this is that bonds answer the why before Forex shows you the how much. Okay, let me repeat that. Bond answers the why before Forex shows you how much. So bonds price the reason, Forex expresses the consequences. Okay, so once you understand that bond markets are expectation markets rather than reaction markets, you stop, yeah, you kind of stop asking why Forex is late and you start using bonds to anticipate where Forex pressure is building before price visibly moves. Okay, so the bonds is always the bond markets is always giving you hints if you are paying attention. Okay. So let's break down the actual transmission mechanism because this is where things stop being abstract and start becoming very practical for trading. So bond yields matter for Forex because yields define return. And return is what drives capital flows. Currencies are not valued in isolation. They are valued relative to each other. When yields in one country become more attractive than yields elsewhere, global capital relocates toward that country. To do that, okay, investors need the local currency. That creates demand for the currency, and Forex prices adjust. But here's the nuance most traders miss. It's not just about whether yields are high or low. It's about whether yields are improving or deteriorating relative to other countries and whether those yields compensate investors for inflation or risk. Okay, so when bond yields rise because growth expectations are improving and inflation is under control, that tends to attract capital in a very stable way. Forex moves that are driven by this type of yield increase tend to trend and persist. Okay, when yields rise because inflation fears are increasing or fiscal credibility is questioned, the Forex response can be very different. Capital may demand higher yields, but not necessarily want the currency. So in those cases, you can see bond yields rise while the currency struggles or even weaken sometimes. Okay, so this explains why Forex sometimes fails to respond correctly in some sense, okay, to yield moves if you're only looking at the direction of yields without understanding the reason behind them. Okay, so what's important here is that as a Forex trader, okay, the question is never simply are yields up or down? Okay, you actually need to ask yourself the real question, okay, which is are yields becoming more attractive in a way that pulls capital in, or are they rising for defensive or risk-related reasons? Once you start thinking in terms of capital flow logic rather than indicators, Forex price action becomes much, much easier to interpret, okay, and to understand even. Okay, so now let's talk about how this actually changes the way you trade, because this is where most people get it wrong. Okay, watching the bond yields is not about finding entry, it's about forming bias. Okay, you are not using the bond market or whatever information to help you get in and out the market. It is just helping you it's just giving you a directional bias of where the markets is going. That's why I say when you do technical analysis alone, you kind of already have a directional bias of where, not just a directional bias, a bias of where price is going, right? But if you combine it with fundamentals and other things, it kind of confirms and it gives you confirmation of where price is going. So I'll give an example. If technical analysis is showing you up, but fundamental analysis is showing you down, it means that there is no confluence, there is no correlation, and your charts or your setup or whatever it is most likely is not high probability. Okay. When everything is pointing in the same direction, it means that you have a high probability setup, you have a high correlation setup, and it will give you your losing rate will decrease a lot. Okay, so if bond yields are trending in a particular direction consistently, what that tells you that, okay, is that the macro current underneath the market is where the direction is. Okay, so Forex may not reflect it immediately, but pressure is building. Okay, so when Forex finally breaks structure, it often does so aggressively with follow through because the capital flow story has already been established. This is why some breakouts feel clean and others failed instantly. Okay, clean breakouts tend to align with bond market direction. Failed breakouts often fight it. Okay, so for example, if US yields have been rising steadily for weeks, the US dollar pairs are still ranging. Okay, that does not mean the dollar is weak. Okay, it often means positioning is still adjusting. Okay, when the forex market finally accepts the bond signals, the move tends to be sharp. Okay, the professional mindset here is patience. You don't trade every tick. You observe whether bonds and forex are aligned or misaligned. If they're misaligned, you wait. If they're aligned, you execute with confidence. This approach reduces overtrading, improves timing, and most importantly, keeps you trading with the macro flow rather than against it. You stop reacting to noise, start positioning for inevitability. Okay. And that's why the bond yields don't just matter for Forex traders. They quietly tell you where the market is going before Forex even admits it. Okay, let's move on to understanding yield curves as recession and trend indicators. Okay, now we're moving into one of the most important concepts in macro trading, and honestly, one of the most misunderstood. So people hear yield curve and they immediately jump to one dramatic conclusion, like, oh, recession is coming, or inversion means crash, okay? Um, Okay, so because that idea spreads so fast online, traders start treating the yield curve like magic indicator that predicts the future with one simple signal. Okay, but the truth is, the yield curve is not a fortune teller. It's a live, constantly updating picture of what the bond market believes about the future. So let's build this from the ground up in a way that feels intuitive, not academic. So when we say yield curve, we are talking about the interest rates the market demands for lending money to the government for different lengths of time. You can lend for 3 months, 2 years, 10 years, 30 years. Each maturity has a yield. If you plot those yields on a graph, you get a curve. That curve is basically the market's pricing of time, risk, inflation, uncertainty, and growth expectations. Now, here's the first key mental model. The curve is not just rates. The curve is the market's belief system. The short end of the curve, okay, think 3 months to 2 years, moves mainly because of central bank expectations. If traders believe the Fed will hike, the short end jumps, right? Okay. If traders believe the Fed will cut, the short end drops. It's sensitive, reactive, and heavily influenced by speeches, inflation prints, employment data, and anything that shifts the next meeting expectations. Okay, the long end of the curve, think 10 years and beyond, moves more like a referendum on the future. It reflects long run growth expectations, long run inflation expectations, and confidence in the system. The long end can move even when the central bank is doing nothing because it's responding to the market's belief about what the economy will look like years from now. So when you look at the yield curve, you're effectively looking at the relationship between two big forces. what policy is expected to do soon versus what the economy is expected to do later. And the shape of the curve is the story. It's a normal environment. The curve slopes upwards. Long-term yields are higher than short-term yields. That makes sense because lenders demand compensation for time and uncertainty. If you lock your money away for 10 years and you want a higher yield than locking it away for 3 months, okay, that makes total sense. A steep curve usually signals optimism about future growth and healthy demand for credit. It's the market saying we believe the economy can handle higher rates over time, and we believe growth will continue. When the curve flattens, it's the market starting to question that story. Okay, so I did put the examples here of curved and flat. Okay, so it's still positive but less enthusiastic. Flattening often happens when the central bank is hiking the short end higher while the long end doesn't rise as much because long-term growth expectations aren't improving. In other words, policy is tightening, but the market is not convinced the economy can sustain that tightening indefinitely. And then we have the curve inverts. This is where everyone gets dramatic. Okay, short-term yields become higher than long-term yields. That is not just a pattern, that's the market saying something very specific. Policy is tight now, but we believe future growth will slow enough that rates will eventually have to come down. That's why the yield curve is so powerful. It's not predicting a recession because it's magical. It's reflecting the bond market's collective pricing of future conditions. It's the most liquid macro expectations market in the world, and it forces honesty because the real money is behind it. Okay, so now for forex traders, why does this matter? Because Forex is highly sensitive to regimes. Trend behavior changes when the curve changes. Correlations change when the curve changes. Volatility changes when the curve changes. So I want you to treat the yield curve as your regime compass, it's not a buy or sell signal for sure. Okay, it's a compass. It tells you what kind of environment we are in. Okay, and therefore what kind of behavior you should expect from currencies. If the curve is steepening, the market is generally pricing growth resilience, stronger risk appetite, and friendly environment for cyclical currencies. If the curve is flattening, you should start expecting more two-way price actions, more sudden reversals, and less reliable trend continuation. If the curve is inverted, you need to understand you're in a regime where market psychology becomes more defensive and sensitive to downside surprises. And one more thing that's really important, the yield curve doesn't move just because of the US, okay? That is not what it is here. The US doesn't just move the entire market, okay? It moves the market, but it's not entirely them, okay? So it's an anchor for the entire global pricing of money. The US curve influences global bond markets, capital flows, and relative return expectations. That flows straight into Forex because Forex is basically the scoreboard of global capital competition. As we move forward into the next slides, I want you to hold this one idea tightly. The yield curve is the bond market's storyline. Okay, so if you can read the storyline correctly, you start being surprised by the Forex moves. You kind of already anticipate where the Forex market is kind of going to move. So you start anticipating the environment where these moves are becoming likely. Okay. Okay, now let's address the big question everyone has because this is where you can lose or gain a lot of credibility. Okay, as a trader. Okay, so people will ask, does the inverted yield curve mean recession? Okay. And the clean, honest answer is it increases recession probability. Okay. But it doesn't tell you timing and it doesn't tell you the severity. Okay. So let's unpack why the inversion has such a strong track record historically. And then this is important part of how it actually changes what you should do as a forex trader. So when short-term rates are high, it means policy is restrictive. Business borrows at short-term linked rates. Okay. Business will borrow at short-term linked rates. Okay. Mortgages, corporate credit line, floating rate debts, these gets pressured. Higher short-term rates raise the cost of money in the real economy. At the same time, when long-term yields are lower than short-term yields, it tells you the bond market believe that tightness will not last. Why would long-term yields be lower? Because long-term yields embed expectations that future growth will slow and future inflation will ease. And if growth slows enough, the central bank eventually cuts rates. Okay, the market prices that future easing, which pulls the long end down. So the inversion is basically the market saying tight policy now is likely to create weaker growth later. But here's the nuance most traders miss. The inversion itself doesn't cause the recession. Okay, it reflects the conditions that often lead to recession. And because it reflects those conditions, it is a reliable warning sign. Now let's connect this to Forex in a very practical way. Okay, Forex trends thrive when there's clarity, when growth is accelerating or decelerating clearly, when policy direction is clear, when the relative story between two economies is obvious. In those regimes, you get clean moves and follow through. But when the curve flattens and inverts, when it really, what it's really saying is the market is increasingly uncertain about the sustainability of growth and it's increasingly sensitive to downside risks. The psychology shift is massive. In a flattening or inverting regime, you tend to see three behavioral changes that matter for forex traders. Okay, the first one will be that volatility becomes more event-driven. Instead of trend continuation being the default, the market becomes very reactive to data surprises. A single CPI print, a single job report, a single central bank speech can change the pricing of the short end and therefore whip Forex around. Okay, traders who rely on smooth trends often struggle here because the market is no longer trending for months of easy momentum. It's trading expectations and expectations can flip quickly. Okay, so second, correlations tighten and then suddenly break. During risk-off episodes, you might see USD strength across the board, yen strength, commodity currencies weakening, emerging markets under pressure. But then you can also see strange moments where the USD strengthens while equities rise, or USD weakens while yields rise. Because the market is juggling competing narratives, recession risk versus inflation risk versus policy credibility. This is where traders who only use one rule get chopped. The environment demands context. That your edge shifts from riding trends to managing regimes transitions. This is where you want to trade smarter, not more. You want to become pickier about pairs. You want to reduce the numbers of random trades. You want to respect that reversal become more common. Okay. And even if you're a technical trader, the macro backdrop affects how price behaves around your levels. Okay. So inverted curve regimes tend to punish lazy breakout chasing and reward patience and mean eversions awareness. Now, I want to highlight something that many people get wrong. Traders often focus on inversion as the recession signal, but the entire cycle matters. The curve often steepens into a cycle early on when growth is strong. Then it flattens as the central bank hikes and the market starts worrying around about late cycle pressure. Then it inverts when the market believes policy is tight enough to eventually force slowing. Okay, so then later, this is the twist. Okay, curves often re-steepen again as the market prices cuts and recession reality becomes clearer. So if you only watch inversion, you miss the transition stages, and those transition stages are where Forex behavior changes first. So, for example, a flattening curve can already start degrading trend quality in Forex. You might see trends, okay, but they become more fragile. Breakouts fail more often, pullbacks go deeper, momentum dries up. That's a signal to shift your trading style before the obvious recession narrative hits the headlines. So what should you do as a trader? You don't trade recession, you trade the market's pricing of recession probability, and the yield curve is one of the best windows into that pricing. When the curve is flattening, you start becoming cautious about overly aggressive trend assumptions. When it inverts, you become more defensive in how you size and how you manage trades. And when it begins to re-steepen, you start preparing for those next phase, which is often a shift in US dollar behavior and a shift in which currencies lead. So the takeaway is this: the yield curve is not just a recession indicator, it's a Forex environment indicator. It tells you what kind of market behavior you should expect, and that alone can dramatically improve your trade selection and your ability to stay calm. Okay, so now let's turn this into something you can actually apply without needing a PhD or a Bloomberg terminal, because the point of this webinar is not to make you a bond trader, it is to make you a Forex trader who understands that environment they are in. Okay, you need to understand the environment that you are in. I want you to start thinking of the yield curve as a trading signal, trading filter, not a signal. Okay, a filter. A signal tells you to buy or sell. A filter tells you whether the market is likely to reward the type of trade you want to place. If you like trends, you want an environment that supports trends. If you like mean aversion, you want an environment that supports mean reversion. Okay, the curve helps you decide which environment you're in. Let's talk through the curve phases like a professional framework. Phase 1 is steep curve. Okay, this is typically early to mid-cycle when growth expectations are relatively healthy. In this phase, risk appetite tends to be more stable, credit is available, and the market is not constantly obsessed with recession risk. Okay, in Forex, this tends to support cleaner directional moves, particularly in cyclical and high beta currencies. Carry trades can perform if global conditions are supportive. In this phase, when you see a breakout, there's a higher chance it holds because the macro environment isn't trying to kill the trend every week. Okay, phase 2 is the flattening curve. Sorry, I didn't put it there, but the flattening, okay, it's basically flat. Okay, this is the warning sign. It's not necessarily bearish yet, but it's the market starting to price the cost of policy tightening or limits of growth. In this phase, you start seeing more two-way price action. The market becomes more selective, more pairs trends beautifully, others chop violently. Your job here becomes a pair selection and patience. Instead of trying to trade everything, you focus on cleanest relative story. If the US is still outperforming Europe, maybe EUR/USD trends lower. If Japan is still stuck with low yields, USD JPY may trend, but with bigger pullbacks, the key is you tighten your standards. Okay, phase 3 is inversion. This is the regime shift. Markets I'm gonna write here flat so you know what I'm talking about. Okay, page three, which is inversion. The markets become hypersensitive to bad news. Volatility spikes because more becomes more common. Risk sentiment can swing quickly. In Forex, this is where safe haven dynamics can dominate. Until they don't, because policy expectations can flip fast, this is where you see a lot of traders get chopped because they keep trading like it's phase one. They keep expecting clean continuation, but the market is now priced for fragility. Okay, the correct adaptation here is to reduce aggressive trade, fewer setups, and be very intentional about where your risk sits. You can still trend trade. You need to be realistic. Trend may be shorter lived and more vulnerable to reversal. Okay, so phase four is the re-steepening, and this is the phase that catches people off guard. Re-steepening can happen for good reasons or bad reasons. It can steepen because growth is improving, which is bullish, or it can steepen because the market prices aggressive rates cuts and recession reality, which is not bullish in the short term. This is why you can't treat steepening as automatically positive. You need to know whether the steepening is coming from the short end collapsing, the long end rising, or both. And this is where the yield curve becomes incredibly valuable for Forex traders because it tells you when the dominant driver is changing. If the curve re-steepens because the short end falls, meaning the market is pricing cuts, okay, that can shift USD behavior. Sometimes the US dollar strengthens early because of risk off and liquidity. Then later, the USD weakens because rate differential compresses. Traders who only know USD is a safe haven gets trapped holding USD longs to late into cycles. Curve awareness helps you avoid that trap. Okay, so let's continue to short end versus long end yields. Yeah, I was spending a little bit too much time on the last subtopic. I don't know if I can finish the slides in 1 hour, but I'll try my best because we are going a little bit more in depth than usually. I do want you guys to understand as in-depth as possibly. Okay, so now let's zoom into the short end of the yield curve because this is where forex traders usually feel the action first, and also many traders get misled if they don't understand that what they're actually looking at. So we talk about the short end. We are usually referring to maturities like the 3-month bills, 6-month bills, 1-year bills, and especially 2-year treasury. So the short end is essentially the market's live scoreboard for central bank expectations. It answers one dominant question. What does the market believe the central bank will do next? And how confident is it in that belief? Every inflation prints, every job reports, every central bank speech feeds directly into the short end. That's why you often see the 2-year yield spike or collapse within minutes of economic data. It's not reacting emotionally, it's repricing probability. If the market suddenly believes the central bank needs to hike more, the short end jumps. If the market believes cuts are coming sooner than expected, the short end drops hard. So for forex traders, this matters enormously because the short end directly influences carry and funding costs. When you hold a currency, you are implicitly exposed to its interest rates. If the short end of US yields is repricing higher relative to other countries, holding US dollar becomes more attractive from a carry perspective. That can support the dollar even before longer term investors have fully repositioned. This is why Forex can react very aggressively to short end moves. Okay, let's move on. Okay, now let's contrast with the long end of the curve because this is where the deeper truth about the economy tends to surface. When we talk about the long end, we're usually referring to the 10-year and beyond. Okay, so this part of the curve moves much more slowly, but when it moves with conviction, it carries a lot of weight. A long end reflects long-term growth expectation, long-term inflation expectations, and confidence in the economic and fiscal framework. It's less about what the central bank might do next month and more about whether the market believes the economy can sustain growth over many years without destabilizing inflation or debt dynamics. This is why you'll see sometimes situations where short end yields are rising aggressively because the market expects more hikes, but long end yields barely move or even fall. That's the bond markets quietly saying we don't believe the tightening will last and we don't believe growth can absorb it indefinitely. Okay, for forex traders, this distinction is critical. Moves in the long end tend to be more structural and more reliable for medium to long-term currency trends. When the long end rises because growth expectations are improving and inflation is seen as manageable, currencies associated with the economy tend to perform well over time. These are the environments where forex trends persist, pullbacks are broad, and macro alignment feels smooth. On the flip side, when long end yields fall despite strong short-term data, that's often a warning sign. It suggests that the market is losing confidence in the sustainability of growth. Forex moves driven purely by short-end repricing in those environments are more likely to fade. Think of the long end as the market's memory and conviction. It doesn't react to every data print, but when it shifts direction, it's telling you that the underlying story has changed. So if you are a trader who likes holding positions for days or weeks or long and deserves far more attention than it usually gets. Okay, it's often the difference between catching a trend that lasts and chasing a move that exhausts itself very quickly. Okay, so let's quickly move on to the most challenging but also the most revealing environment for forex traders when the short end and the long end of the curve disagree. Okay, so this is what we call distorted curve environment. The short end may be screaming tighter policy, higher rates, or persistent inflation pressure, while the long end quietly signals skepticism about growth and long-term sustainability. Or the opposite can happen, where the short end collapses or expected cuts, while the long end rises because inflation credibility is being questioned. These disagreements are not random. They usually occur during macro transition phases when the market is shifting from one dominant narrative to another. And during these phases, forex behaviors often become unstable. Okay, from a trading perspective, this is when you see the most frustration. Breakout fail, trends start to stop abruptly, correlations that worked beautifully a few months ago suddenly break. Traders who rely on one dimensional logic feel like the market is out to get them. But from a macro perspective, um, what's really happening is that the market hasn't reached consensus yet. Different parts of the bond markets are pricing different futures. Forex, being the expression of relative capital flows, gets pulled into multiple directions at once. This is why short end driven forex moves in these environments are often sharp but short-lived. The market reacts to policy expectations, then hesitate because long-term confidence isn't there. Without alignment between short end and long end yields, forex trends struggle to sustain momentum. For forex traders, okay, the professional response is not to trade harder, it's to trade smarter. You reduce expectations, you become more selective, you stop forcing multi-day holds in an environment that's not designed to reward them. Okay, it is also where patience become a competitive advantage. Many traders feel pressured to trade every single day. I personally only trade once a week, if not at most twice a week. Sometimes I don't even trade at all for the week. Okay. Professionals understand that some environments are about capital preservation and information gathering. When the curve is distorted, the market is effectively telling you, okay, we're in transition, wait for clarity. And here's the encouraging part. Okay, these transition phases don't last forever. Eventually, the curve resolves. Either the long end starts confirming the short end, or the short end reprices towards the long end. When that alignment happens, forex often breaks decisively, and those moves tend to be very, very powerful. Okay, so I'm going to continue to the last part of today's webinar, and we only have like 10 more minutes left. I hope that we can finish in time. Hope I don't drag into too much of your time. Okay, we're going to understand the last part, which is the bond forex divergence as a trading signal. Okay, all right, guys. The final subtopic for today is where everything we've talked about today really comes together. And it's also where a lot of traders either gain a massive edge or completely misunderstand what they're seeing. We're going to talk about bond forex divergence. And what I want to be very clear from the side is divergence is not a trade signal. It is a state of tension in the market. Most traders see divergence and immediately think, okay, one of these markets is wrong, so I should fade it. Okay, that mindset alone causes more losses than almost anything else in macro trading. Divergence is not the market inviting you to be clever. It is the market telling you that something is not resolved yet or something is not being aligned. Okay, to understand this properly, you need to remember the roles each markets play. Okay, bonds price expectations, they price growth, inflation, and policy belief. Forex prices flows. Okay, it prices what capital is actually doing right now. Because of that, it is completely normal for bonds and forex to disagree temporarily. For example, bond yields might start falling because the market believe growth will slow in 6 months. Forex, meanwhile, might stay strong because carry is still attractive today and capital hasn't moved yet. That's not a mistake. That's a timing difference. Divergence happens because markets operate on different clocks. Bond markets are forward-looking. Forex markets are reactive and flow-driven. When those clocks are out of sync, divergence appears. And here's the key insight. I really want you to internalize, okay? Divergence is information. It's not instruction. Okay. When you see bond yield signaling something that Forex is not yet reflecting, it tells you pressure is building. It tells you that the current Forex price may not be stable long term, but it does not tell you when the resolution will happen or in which exact form. Professional traders don't use divergence to jump in early. They use it to prepare mentally. They start thinking in scenarios. If bonds are right, Forex will eventually have to adjust. If bonds are wrong, yields will snap back. Either way, something is likely to move. So divergence is the best thought of as a market imbalance, like stretching a rubber band. It can stay stretched longer than you expect, but when it releases, the move is often fast and decisive. This is why bond forex divergence is such a powerful concept. It doesn't give you entries, it gives you awareness, and awareness is what keeps you from forcing trades in unstable environments. Okay, so now let's talk about the most important practical lesson here. Because this is where traders lose money even when their macro read-in is technically correct. Early divergence is usually a warning, not an opportunity. Imagine this situation. Bond yields are falling steadily, signaling slowing growth and eventual easing. Forex, however, remains strong because short-term yields are still high and carry is attractive. A retail trader looks at this and thinks bonds are right, Forex is wrong. I should short the currency now. That trader may even be directionally correct over the next 3 months, but they often get stopped out 3 times before the move actually happens. Why? Because divergence can persist far longer than expected. Markets do not resolve divergences on your timeline. They resolve it when flows change. Okay. And flows usually change only after catalysts like data confirmation, policy shifts, or risk events. This is why early divergent phases are some of the most dangerous environments for traders who feel the need to always be in a position. Price action becomes erratic, breakouts fail, reversals don't follow through, the market feels messy, not because it's irrational, but because it's undecided. In these phases, divergence is telling you something extremely valuable. The profitability of clean continuation is low. Okay, that alone should change your behavior. It should make you trade smaller, trade less, or sometimes not trade at all. Okay, so doing nothing during divergence is not laziness, it's pure discipline. Staying out of the market is pure discipline when you have to. Okay, another mistake traders make is treating divergence as a confirmation bias. They already want to be bullish or bearish, and divergence becomes an excuse to enter early. Okay, this usually ends with emotional trading and frustration. Professionals do the opposite when divergence appears. They slow down, they observe, they wait for alignment, and they let pictures show them when the market has chosen a side. Okay, so be patient, don't jump into things. Okay, so now let's finish this by talking about how professionals actually use bond forex divergence in practice, because this is where it becomes a real edge rather than just an interesting concept. Professionals use divergence to form bias, not to force trades. When bond and forex diverge, okay, they start building a mental map. They ask questions like, if bonds are right, what needs to happen for forex to follow? When data would confirm this, what policy shift would accelerate it? Where are the key forex levels that would break once flow changes? This turns divergence into preparations rather than prediction. For example, if bond yields are falling and forex hasn't moved yet, a professional trader doesn't immediately short forex. They wait for confirmation. That confirmation might come in a form of weaker data, dovish central bank language, or a break in forex structure that aligns with the bond signal. Okay, once that alignment happens, the trade quality improves dramatically. Moves that occur after divergence revolves tends to be faster, cleaner, and more emotionally comfortable to hold. Okay, why? Because expectations and flows are finally moving in the same directions. Okay, this is also where risk management improves. Instead of holding positions for weeks, holding the market eventually agrees with you. You enter once the market has already started to agree. You stop placement becomes clearer, and your conviction is based on alignment and not hope. Okay, so that's all I have for you guys today. I hope you guys gain something from today's webinar. Okay, I do see a question here. It was there for a while now, so let me answer you. If bonds usually lead forex, why do we sometimes see forex move first? Okay, that is a very good question. Okay, and a very good observation actually, and it is true. Sometimes forex move first. So forex sometimes, like I said, move because when that happens, it's usually because flows are reacting faster than expectation. Forex is very sensitive to positioning, risk sentiment, and short-term capital movement, especially during shocks of surprise events. Okay, so bond leads when the market is repricing the future. Forex leads when the market is reacting to the present. The key is to not decide which one is always right, but to recognize which one is in control at that current point of time. Okay? What's the biggest mindset shift traders need when using bonds in Forex trading? Okay, so, stop trying to be early. Okay? I know there are a lot of webinars, a lot of videos out there that will tell you like, if you do this, you can be early. You blah, 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 you can be early. Okay, I won't say it's wrong to be in the market early, but I think patience is very important. Okay, sometimes being early feels smart, but it can end up being very expensive. Okay, professionals trading is about being aligned. Being aligned is more important than being early. Okay, it's not about being first. Okay, so bonds help you see what's coming, but patience is what allows you to actually profit from what is actually coming. Okay. Okay, so if you guys don't have any more questions, I mean, I personally don't see any more questions. Let's bring everything together and close this session and this webinar properly, because I want you to walk away with clarity, not just more information. The biggest idea I want you to remember from today is this: Forex does not move in isolation. If you trade currencies without understanding bonds, you are always reacting, never anticipating. Okay? And reaction is one of the biggest reasons traders feel stressed, rushed, and constantly a step behind the market. Bond markets are where the macro expectations are formed. They price growth, inflation, and policy beliefs long, long before those ideas show up clearly on Forex charts. Forex then responds when capital flows actually adjust. That sequencing matters. It explains why Forex sometimes feels late, why breakouts sometimes fail, and why certain trends suddenly accelerate without warning. Okay, so understanding the bond market will help you have an edge when you are trading. Okay, so I don't see any more questions. I hope you guys learned something from me today. If you did not pay attention the entire 1 hour, at least take this away. If you are a forex trader, you will need to understand the bond markets. Okay, I won't say you need to, but understanding the bond markets will help you find more probability, high probability setups, because you now have the directional bias and you now have the bias of where the markets are moving. Okay, so that's all I have for you guys. Thanks, guys, for joining. I will see you guys in 2 weeks. I won't be taking you guys next week because I will be traveling next week. So my teammate Woon, he's also a very good analyst, will be taking you guys next week. I think the topic will be, what is the topic for next week? Let's find out. Next week, you guys will be going through central bank and the markets. I know we do central bank a lot, but this time will be central bank against the markets. Okay, so uh yeah, that's all I have for you guys today. I will see you guys in a week. Thanks for joining. Wait, do I have another Q&A? Thank you so much. Yes, more clarity instead of more information. Yep. Thank you so much. Thanks, guys. Okay, see you in 2 weeks. Take care. Bye.